the job market may be even weaker than what the government reported today. For that, we turn to our roundtable with Todd Harrison, the CEO of Minyanville Media. Todd has almost 20 years experience on Wall Street, including 7 at Morgan Stanley. His company is an Emmy award-winning firm focused on educating the public about the financial market. And also with us is our own Joe Brusuelas. Joe was at moodyseconomy.com and the chief economist at Merck before joining us right here at Bloomberg. So guys, good to have you with us. A lot to talk about with this report. Todd, let me ask you first. I mean, the president says we're moving in the right direction. This jobs report would say otherwise, wouldn't it?
Well, if there was going to be a jobs report that was going to beat, this was going to be the one. It had the upside census skew. But I take all of these reports with a grain of salt. I believe there's about 1 in 6 Americans currently underemployed. So I think this number is not telling the whole story. And obviously, you know, to say it's a better report, to tell that to a college graduate who can't find a job or somebody who's having his home foreclosed upon, there's a lot of issues out there. There's only so much that jawboning is going to do in terms of putting lipstick on the proverbial pig.
I would say if there's going to be a job report that was going to miss, it had to be this one, because everybody was so complacent and felt so comfortable saying no problem. We're going to totally beat this tomorrow. That's like the immediate sign that you're going to miss it, right? And that markets are going to tank. I mean, Joe, why was everybody so confident?
Well, it had to do with the fact that we were going to get a big census number, and in most of the...
We did get a big census number.
Well, most of the forecasting community was convinced that, you know, private hiring had actually picked up. And indeed, if you look at the internals of the data, it's a little suspect. I still find it a little hard to believe that we're selling all of these raw materials and all these finished goods around the world, yet we're not increasing hiring on transportation and trade and retail to move this stuff. I wouldn't be surprised if we see the data actually revised upward. But here's the thing. You can get 150 to 200,000 private jobs created each month. That's not sufficient. We need to create 300 to 400 a month to begin making a dent in the 8 million we've lost.
Let me ask you about the market and how it's playing in that, because you know, Todd, there's a lot of selling in the market. I brought up this, Matt and I both have brought it up, where, you know, the expectation that with a weaker jobs report, that rates are going to stay much lower or stay low much longer than everybody anticipated. Typically a good backdrop for the stock market. I know there's a lot of other concerns. It's never just black and white here. But I mean, does the selling that we're seeing today make sense in your view? A lot of selling and broad-based selling.
Well, I think the story is coming out of Eastern Europe and Hungary and Greece and Romania. And people are quick to say, well, you know, how does that affect us? And those are symptoms. Those are not necessarily causes. But with the derivative machination tying the world together, they very much do matter. The counterparty risk in Europe carries over to the United States. So that is what I think is the backdrop. The jobs number came, and traders are traditionally ADD. The good news, if there is good news, is that the flash crash lows of 1065 held by the skin of their teeth on the close. They've held every time since the flash crash.
That's significant.
That is technically significant. They're holding on by their fingernails, but 1040 is the level that has to hold the February lows. Right. So I wouldn't be surprised to see something over the weekend again to try to prop the market up. But it's medicine that cures the disease versus drugs that mask symptoms.
What's your focus as a trader? I mean, you've been trading for 20 years now, right? I mean, when you woke up this morning and saw the Hungary news, did you say, uh-oh, this is the other shoe dropping here?
It's a cumulative effect, and it doesn't come as a surprise. We've been talking about on Minyanville for a long time that these sort of things tend to happen when you keep pushing out risk on the time continuum. So it's very much a cumulative effect, and it's very much something that's been building, and it's not just going to magically go away. We're seeing those effects come into the market, and in my opinion, the medicine that cures the disease is very much debt destruction. It's very much allowing the free market pathway to continue to flush the system out. And once we go through that, then we're going to have a sustainable economic construct.
So let's go back to the economic fundamentals, Joe. I mean, in terms of going through the numbers, we've seen some positive data points, ignoring today's on the jobs report. The economic fundamentals in the U.S. not strong enough to kind of outweigh what's going on over in Europe and in terms of dragging down growth?
Well, no, it's strong enough to create jobs. I think what's going on in Europe is it's creating a global crisis of confidence, where no one's sure when and if the other shoe is going to drop. What happened in Hungary today should really not disturb the markets on a fundamental basis. But the fact is we don't know the financial linkages between U.S., German, Austrian, and Hungarian banks. I mean, what we were seeing today in the markets was quite frankly a little strange.
It's mostly German banks and French banks.
Yeah, German banks, French banks, UK banks.
But we still don't know, you think?
We still don't know. I mean, it was weird. The Austrian banks got hit the hardest today. You wouldn't have think that was the case, but certainly that's what happened.
Todd, just 30 seconds left. What are you looking for Monday? What are you watching over the weekend, Sunday night, Monday morning?
It's going to be a huge headline risk, but I think you hit the nail on the head. It's a crisis of confidence. It's credit of a different kind, that of credibility. It's faith in the system and credibility of the system as a whole. So I expect to see Monday. They're going to try to do something over the weekend. I think they have to.
At the G20, you think?
Well, I don't know if that's the fatal flaw of regulation is that it's a political process where the markets move in real time. So that's the chasm that we're trying to cross.
All right, we got to run. Hey, Todd, thank you so much. Todd Harrison, CEO of Minyanville Media, and also our own Joe Brusuelas here.